Welcome to our special market update. I'll be looking at the S&P and the Forex market. And for those of you who are not members of our free education at candlechartsacademy.com, I strongly suggest signing up. It, as I just mentioned, is free, and there are a lot of free, ongoing educational resources worth many, many hundreds of dollars, but at no cost to you. Okay, so let's look at the S&P for the past couple of months. You know, we've been looking for a target of about 22 to 2300, and so let's see where we stand on that now. So on this recent action, obviously a bull channel, nice bull channel over here. The market really is not overextended. I like it, especially when we have what I call a staircase progression. It's like that song, what is it? Stairway to Heaven. The market moves up and then trades laterally to relieve the overbought condition. And what I mean by overbought is that the market moved up too far too fast and often becomes vulnerable to correction. But when it moves up and then trades sideways like this, it's kind of digesting all the overbought condition and makes it healthier for the market to continue to move up. So here we had this hammer. The market moved up. Now it's relieving the overbought condition. See it back here, same thing here. Got very overextended, moved sideways for a few days, relieved the overbought condition, got a little bit overextended, relieved the overbought condition. And this can go on for a long, long time because it's a self-correcting market. It's not like the parabola, you know, the rally we had in the late 90s in 1999 where it just went straight up without a correction. So this is actually a very healthy way for the market to rally. And so now let's look at the longer term perspective again, and just refresh your memory why, you know, I have that target of 22 to 2300, and essentially we had this. Now we're looking at a monthly chart, and we had a box range, and I'm being conservative. I'm taking this as the bottom of the box range rather than this. So you can see we actually turned bullish back in April of 2013 with a target of 22 to 2300, and the sole reason for that, or the major reason for that, was the break above resistance and this concept that old resistance becomes new support. And indeed, look what happened as the market broke above resistance, and magic. The old resistance became support. So essentially what I did was I took the height of the box range, added to the breakout, and get a target to the 2200 to 2300 area. But as I've mentioned previously, the cautionary approach for those who didn't, get our update or for whatever reason didn't follow it from an investment perspective, I think it's too late to do anything now because the risk is still down here. This is our major support area. So if you're buying it here, your risk is all the way down here, where you're looking for a potential target of about 200, 250 points higher. So the risk is actually greater than the upside potential. So we did have a seminar. It's available actually on demand, where we talk about candles and candles and investing. And this is just one example of how you could use candlesticks and Western technicals to play your longer-term retirement account or your kid's educational account. So that's it on the S&P. I'll do the Forex market in a second for those who trade Forex, but just want to give you a heads up that we will have a really neat new options product. We're partnering with somebody. Look for an email next week or a few emails where you'll be able to automatically scan for the best option trades in any market. Also, if you don't know which markets to pick, it has what's called filtering, and you could find the best stocks using Western technicals, plus you could always add my candles, and then based on that, it'll give you the best option trade to do. So, for example, if you have a watch list of 15 markets or you want to scan the S&P 100, it'll automatically scan it, give you the best trade option, the best option candidates, and you don't even really have to know much about options. But we'll give you details on that next week when we send out an email. I just want to give you a heads up on that because this is the first time ever that we're going to be working with our partner on this, revealing it to our candlecharts.com family. So let me, as promised, do the Forex market for those of you who trade FX, and I'm going to focus on the EURUSD because that's the most popular Forex market. So let me look, and we have the monthly here, but let me go to the daily, show you something interesting. So here This is not a hammer because the lower shadow is a little too, the real body is too long, but notice how it became a nice support area, bullish engulfing pattern here, another bullish engulfing pattern here, and we're at a fairly important juncture here on this daily chart. Now, one of the great things about candlesticks is obviously you could use Western technicals because both candles and Western technicals and bar charts, I should say, use open, high, low, and close. So we are in the process of building a potential head and shoulders bottom. Left shoulder, head, right shoulder. So it's not a confirmed inverted head and shoulders until the market breaks above the neckline. And obviously that's going to be ascending as time progresses. So I'm saying right around the, I'd say 137.20 area to be safe. A close above that would be a break above an inverted head and shoulders. Or you can even view this as a double bottom. See the support area here? Kind of like the S&P with a box range. And just as a heads up, double bottom here and here is not confirmed until we take out the high over here. So we still need, even based on breakout from a double bottom or box range or head and shoulder, inverted head and shoulders, however you want to view it, we still need to close above 137.20. And in that scenario, what should happen is this trend, this angled trend line, this is called an internal trend line. If the market breaks above this, and this is actually also called a neckline of head and shoulders, the neckline should then become a support area. So that's something to keep an eye on. However, right now, the risk is down to the lows here. This is the major support area. So I'm viewing this as a lateral trading environment. And if we close above, even if we close above, actually I'm going to nudge a little bit more. I was saying 137.20, but I'm looking at this area here now. See the resistance for a good 4 out of 5 sessions over here. So I'd have to say close above 137.30 to me would be the major breakout. In that scenario, my target would be the highs up here right around the 140 level. But for right now, view this as a box range. One way to think about trading this is selling at the top end of the range here, anywhere from 137.20 to 137.30. Obviously, always have a protective stop, and maybe 137.50 or higher. And or one could think about buying down here with a protective stop somewhere under 135.